Oil prices continue to surge, rising above $80 a barrel for the first time in 3 years. Joining me now is Evan Lucas, the Chief Market Strategist at InvestSMART. Evan, good to see you. So, will the supply issues come here and what's caused it all to spike?
Yeah, I'll answer the last part of your question first, Pete, in terms of what it is. It's actually probably COVID in terms of the answer. And the reason I say that, remember this time last year, we're actually going back even further, April last year, oil prices were at one point negative. And that actually led to a scenario where prices had basically been charged to be taken. And that was because the whole world had shut down. COVID had therefore put through a whole heap of interruptions and the demand for oil had actually completely evaporated. This time around, it's the opposite. Demand is so high because of the speed and recovery that is going on across the globe because of vaccinations, which is a fantastic thing. We're now having a scenario where supply has actually been caught off guard. We are drawing in the US down about 4.5 million barrels a day. That's a record in terms of how much supply demand we've had. Also, Hurricane Ida over there has also impacted the oil price in terms of where we stand. And then you've also got the fact that OPEC's supply scenario was not as strong as we were expecting. And that therefore has meant we've got this sort of almost perfect scenario where we do have the supply issues, demand is up, demand's only going to get stronger. It's about to go into the cyclical part of the year where we have heating needs over in the Northern Hemisphere for winter. All that's led to that price surge. And it is likely that for us here in Australia, the price could go to as much as around about almost just shy of probably $1.90 per litre, because Brent's likely to go towards 90 to even as high as $100 a barrel, and the Aussie dollar is quite low.
Okay, so that would explain why some of those stocks have been doing well in the last week or so anyway. Meanwhile, Evan, onto the price and the costs of home ownership at the moment. It's always a fairly constant issue, this one. You've got these proposed changes to home loan lending by APRA. So first of all, do you think that's going to work? And then secondly, is this the best way to slow the housing market?
So again, I'm going to answer the last part of the question first. The question always comes with regulation, is that regulation in terms of what we always talk about and how we think about regulation, it's a behaviour changer. So when you have input of taxation, it is technically retrograde and retrospective to how growth happens, and that's fine. That's its desired job. So it is designed to slow it down. It will have that effect. The question is whether or not it's too much of a blunt tool, particularly considering they're now singling out what you and I have been talking about actually for the last sort of probably 8 to 9 months, which is the debt to income ratio. So the amount of debt you hold to the amount of income you have. We know very clearly that the housing market is moving at about 1 to 1.5% per month in growth, whereas your wages are growing at around about sort of just shy of 2 per year. So that's that big issue. And now there is roughly around about 22% of all loans held 6 times more. And that is because technically it's investors. And what investors are doing, they're using the equity in their investments, whether it's across their whole portfolio or one or two, to therefore take the valuation of that and then go and buy another one because the loan valuation of their whole portfolio allows them to do that. So that's what they're trying to tie down, is to slow that down, the amount of debt they're holding. The question is whether or not it therefore takes too many people out of the market, and particularly in Sydney and Melbourne with house prices the way they are, does it actually also impact first homeowners and owner-occupiers? That's the big question. They will probably do some form of carve-outs, but it is a very blunt tool, and it could be a tool that actually distorts the market too much if they don't do some finessing around the regulations. So that's interesting. But in saying that, whenever you see the banks themselves, with the fact that you've seen Shane Elliott and also Matt Common from ANZ and CBA respectively say they need this, suggests it's coming and means it's going to come. It's just a question of how they do it and how they regulate it without completely distorting the market.